One of the most important and frequently misunderstood questions in institutional crypto investment is whether Bitcoin is a genuinely uncorrelated asset or a high beta technology proxy. The answer, supported by a rigorous review of correlation data across multiple market regimes, is that Bitcoin exhibits regime-dependent correlation. It correlates tightly with risk assets during broad market stress events but demonstrates meaningful decoupling during idiosyncratic macroeconomic shocks specific to the traditional financial system. The 2022 experience disappointed institutional investors who allocated to Bitcoin expecting portfolio diversification benefits. As the Federal Reserve began its most aggressive rate hiking cycle in 4 decades, Bitcoin declined by over 65% alongside the Nasdaq, with peak rolling 90-day correlations exceeding 0.75. Institutions that had allocated to Bitcoin as an uncorrelated store of value experienced it as a high-volatility technology proxy during the period when diversification benefits would have been most valuable. The 2023 banking crisis provided the opposite experience. When Silicon Valley Bank, Signature Bank, and First Republic Bank collapsed in rapid succession in March 2023, Bitcoin surged over 40% during a period when regional bank stocks declined by 40 to 60%. This regime-specific decoupling is the empirical basis for Bitcoin's conditional diversification narrative and deserves careful institutional analysis. The 2022 to 2023 market data provides the clearest empirical demonstration of Bitcoin's regime-dependent correlation behavior. During the 2022 Federal Reserve rate hiking cycle, Bitcoin's correlation with the Nasdaq 100 was at its historical peak because the same mechanism drove both. Rising discount rates reduced the present value of long-duration assets, and both Nasdaq technology stocks and Bitcoin were perceived by the market as long-duration assets requiring high discount rates. This regime-specific reasoning is crucial for institutional correlation analysis. The 2022 high correlation between Bitcoin and the Nasdaq was not evidence that Bitcoin is structurally equivalent to a technology stock. It was evidence that during broad risk-off regimes driven by discount rate increases, all long-duration assets correlate. The same pattern would have been observed with gold if gold had not been partially supported by geopolitical safe haven demand from the Russia-Ukraine conflict during the same period. The 2023 banking crisis decoupling demonstrates Bitcoin's behavior during a categorically different type of market stress, systemic stress in the traditional banking system. In this regime, Bitcoin offered something that the Nasdaq did not, an asset with no counterparty exposure to the fractional reserve banking system, no deposit insurance limitations, no bank-specific credit risk, and no Federal Reserve rescue requirement. These properties were specifically valued by investors during the banking crisis in a way that they are not during rate hike regimes. The 3 macroeconomic regimes framework provides institutional portfolio managers with an actionable model for thinking about Bitcoin allocation and its correlation properties. Rather than treating Bitcoin correlation as a fixed number, this regime-based approach recognizes that Bitcoin's correlation profile is a function of the specific macroeconomic stress driving market volatility. Rate hike regimes produce the highest Bitcoin equity correlations because the long-duration asset framing of Bitcoin becomes the dominant market narrative during periods of aggressive monetary tightening. This framing is not structurally correct in the way that it is correct for a 30-year bond, but market pricing behavior during rate hike cycles has consistently treated Bitcoin as a long-duration risk asset regardless of its actual economic characteristics. The banking system stress regime is the most important for the diversification thesis because it demonstrates the specific conditions under which Bitcoin's unique properties, no counterparty exposure, no bank deposit risk, global transferability, and seizure resistance, translate into price appreciation during a market stress event. This regime occurs infrequently but generates the most dramatic decoupling. Institutions that reduced Bitcoin allocation after the 2022 high correlation experience missed the 2023 banking crisis decoupling that was the strongest empirical validation of the Bitcoin diversification case. The correlation data across market regimes reveals that Bitcoin's average long-term correlation with the Nasdaq of approximately 0.30 to 0.40 masks significant regime-specific variation. Correlations ranging from negative territory during banking stress to 0.75 during rate hike cycles represent dramatically different portfolio construction implications. The negative correlation during the March 2023 banking crisis is particularly significant because negative correlation is the holy grail of portfolio diversification, an asset that goes up when the portfolio goes down. Bitcoin's negative correlation with regional bank stocks during the banking crisis, driven by institutional and retail movement of capital from bank deposits into Bitcoin and gold, is the closest Bitcoin has come to demonstrating genuine crisis period uncorrelated behavior. For institutional portfolio construction, The practical implication is that Bitcoin's diversification benefits are conditional and regime-dependent rather than persistent. Institutions that entered Bitcoin positions with expectations of persistent low correlation with equities experienced disappointment in 2022 and positive surprise in 2023. The more sophisticated framing is to model Bitcoin as an asset with specific crisis scenarios where decoupling is expected, balanced by rate hike scenarios where high correlation is expected, and size the allocation accordingly. The regime-aware Bitcoin allocation strategy translates correlation analysis into actionable portfolio management guidelines. The four-step process provides institutional portfolio managers with a systematic framework that prevents both the error of overallocating based on average correlation assumptions and the error of underallocating based on 2022 high correlation experience. Sizing for worst-case correlation during portfolio stress is the most critical discipline. Institutional risk models that assume Bitcoin provides diversification benefits in all market regimes will systematically underestimate portfolio volatility during rate hike regimes. The risk system must model the high correlation scenario as a realistic stress case, not an unlikely tail event. Regime shift monitoring requires tracking indicators outside the traditional crypto analytics ecosystem. Federal funds futures pricing provides forward guidance on rate trajectory. Bank CDS spreads are early warning indicators of banking system stress. Dollar index movements signal currency dynamics that affect Bitcoin's behavior as a non-sovereign monetary asset. Gold correlation changes are particularly informative. Bitcoin and gold tend to correlate positively during debasement fear regimes and may diverge during banking stress when Bitcoin's counterparty-free properties attract specific demand that gold's physical custody requirements do not provide. The 2023 banking crisis analysis from institutional research firms was consistent in identifying the specific mechanism that drove Bitcoin decoupling. The surge in Bitcoin price during the SVB collapse was not driven by generalized risk on sentiment or crypto-specific news. It was driven by a specific set of investors who were re-evaluating the counterparty risk of holding deposits in the traditional banking system and seeking alternatives that did not require trust in a bank's balance sheet or dependence on FDIC insurance limits. This mechanism is distinct from the inflation hedge narrative that has dominated institutional Bitcoin analysis. The inflation hedge thesis requires investors to believe that Bitcoin will maintain purchasing power as fiat currencies depreciate. The banking crisis thesis requires only that investors value an asset that does not require counterparty exposure to a fractional reserve bank during periods when that counterparty risk is elevated. The banking crisis decoupling is more repeatable and more predictable than the inflation hedge narrative because the specific trigger conditions, acute stress in the traditional banking system, identifiable in advance through bank CDS spreads and deposit flow data. Institutions that monitor these indicators can position for Bitcoin decoupling events with more confidence than they can position for the inflation hedge thesis, which depends on investor belief formation about currency debasement rather than observable banking system stress indicators. The Bitcoin decoupling analysis provides institutional portfolio managers with a more sophisticated framework than the simple Bitcoin as diversifier narrative that was tested by the 2022 high correlation experience. The regime-dependent correlation model explains both the 2022 disappointment and the 2023 banking crisis success, and provides predictive guidance for future allocation decisions. The key institutional insight is that Bitcoin's portfolio properties are conditional on the macroeconomic regime driving market volatility. In rate hike regimes, Bitcoin behaves like a high beta technology stock and provides minimal diversification. In banking system stress regimes, Bitcoin demonstrates the specific uncorrelated properties that justify a diversification allocation. In between, Bitcoin's correlation is moderate and its portfolio contribution is primarily driven by directional price exposure. Institutions that understand this regime-dependent structure can make better-informed allocation decisions, size positions appropriately for each regime, and avoid the common errors of either overallocating based on average correlation assumptions or underallocating based solely on rate hike period experience. The empirical record is clear. Bitcoin's portfolio behavior is complex, conditional, and requires regime-aware analysis rather than time-averaged correlation statistics.